Right now, shares of Tilray brands, trading under the ticker TLRY, are sitting at 1.07, down just under 1% on the day. The stock is oscillating in a tight range, having opened at 1.06 and trying to fight its way back to the 1.09 mark on volume that is already climbing past 11 million shares. This is the classic Tilray grind, a stock that so many investors look at as the ultimate long-term legalization lottery ticket, a company that will supposedly erupt the moment the United States federal government finally gets its act together. That is the expectation. But the reality of what is moving this stock today and what has been pressuring it for the last week has very little to do with that grand optimistic vision. The immediate reality is a legislative dagger. Just a few days ago, a new U.S. government spending bill included a provision that directly targets Tilray's entire U.S. strategy. This provision is set to recriminalize most hemp-derived THC products, like Delta-8, by late 2026. This isn't just a minor regulatory headline. This is a direct shot at the very pathway Tilray has been building through its wellness and beverage acquisitions, hoping to use hemp-derived THC as its Trojan horse to establish brands and distribution before full-scale marijuana legalization. The company, of course, came out with a statement saying it expects no material revenue impact. But the market is not so sure, and that's why the stock is struggling to find its footing. This single legislative provision throws the entire expectation narrative into question. For years, the common belief has been that Tilray, led by CEO Irwin Simon, is playing the long game. The plan was to acquire craft beer brands and wellness companies like Manitoba Harvest, build a massive CPG distribution network across the United States, and then, when the legal walls fall, simply flip a switch and push THC products through that established legal network. It sounds brilliant. The reality, however, is that this strategy is proving to be incredibly expensive and is now facing a direct legal threat that could make that entire hemp-based entry point evaporate. The market is suddenly being forced to reevaluate. What if the Trojan horse is lame? This forces investors to look at Tilray not as a future U.S. cannabis giant, but as what it is right now: a Canadian cannabis producer struggling with price compression in its home market, a European medical distributor, and a collection of craft beer brands. The recent earnings report from October showed this tension perfectly. They beat expectations, posting a 0.00 earnings per share figure when a loss was expected, and revenue also came in slightly ahead of forecasts. But dig one layer deeper, and you see the core problem: a staggering negative net margin of over 250%. The company is not profitable, and its diversification, while growing revenue, is not yet fixing the bottom line. This stock is and has always been a battleground defined by headlines. We are only 2 months removed from a single social media post from Donald Trump who mentioned supporting CBD for senior health care, which caused the same stock to spike over 41% in a near-vertical move. Now, a single provision buried in a spending bill has it pinned back down. This is the life of a Tilray investor: absolute dependency on the whims of Washington. The stock trades not on fundamentals, but on political tea leaves. And speaking of battlegrounds, we have to talk about the short interest. This is a critical component of the Tilray story. Right now, official data shows about 100 million shares are held short. That is a massive number. It translates to roughly 9% of the float. Now, 9% is significant, but it's not the kind of number that screams an imminent GME-style squeeze. The days to cover is also very low at just 2.4, meaning it would take less than 3 average trading days for all shorts to close their positions. But the most interesting part is the borrow fee rate. The cost to borrow shares to short them is currently just 0.68%. That is incredibly cheap. This tells us that despite the high number of shares short, large institutions are not scrambling for shares to borrow. There is no panic among the shorts. They are not being squeezed, they are comfortable. So what is the short thesis? It's not a conspiracy, it's the fundamentals. The short thesis is that Tilray is a company that continues to burn cash, that remains deeply unprofitable, and whose core Canadian market is saturated and seeing margins collapse. The short thesis is that the U.S. legalization dream is not a matter of if, but when, and when keeps getting pushed further and further out. The thesis is that the recent acquisitions in the beverage space are a desperate attempt to show revenue growth, but that they have paid high prices for assets in a completely different, highly competitive industry, all while diluting shareholders to fund these purchases. The recent legislative blow against hemp products only strengthens their case. They are betting that the company cannot achieve profitability before it needs to raise more and more capital, further diluting the very investors hoping for a payday. What's your take on this? Do you think the short sellers are accurately pricing in the regulatory risk, or are they just pushing fear on a stock they see as an easy target? Let me know in the comments. For retail investors, it's critical to know how to track this. You can find short interest data on platforms like Fintel or Ortex. You're looking for a few key signals. First, the short interest as a percentage of the float. When this starts climbing into the 20 or 30% range, things get interesting. Second, and more importantly, look at the borrow fee rate. If that 0.68% rate suddenly spikes to 50, 100, or 200%, it means the shorts are in trouble. It means shares are scarce and they are paying a high price to maintain their negative bet. That is the fuel for a squeeze. We are nowhere near that now. Another figure to watch is the off-exchange short volume, which for Tilray has been consistently high, often 40 to 50% of all volume. This is often cited on Reddit and X as a sign of manipulation, but it's more accurately a sign of large block trades and institutional activity happening away from the public exchanges. It's not inherently illegal, but it does obscure the full picture of buying and selling pressure. We also saw a significant spike in fails to deliver back in late September and early October, where millions of shares were failing to be delivered to their rightful owners, peaking at nearly 8 million shares on a single day. That situation has since cooled off, but it shows that the plumbing of this stock has been under stress before. Chasing a short squeeze is exceptionally risky. It's far more important to understand why the shorts are there in the first place. While the short thesis is compelling, there is a counter-narrative, and it's coming from inside the house. In the last 6 months, Tilray's own executives have been buying shares. CEO Irwin Simon purchased 165,000 shares, and the financial officer, Carl Merton, bought over 33,000. This is not a trivial amount. Insiders sell for many reasons: tax planning, diversification, buying a house, but they generally only buy for one. They believe the stock is going up. This is a powerful bullish signal that directly contradicts the short thesis. At the same time, institutional ownership remains incredibly low, at less than 10%. This is a retail-dominated stock, but we have seen some interesting moves. Citadel, one of the largest market participants, massively increased its position, adding over 5 million shares in the last reporting period, a 1,600% increase in their holdings. Geode Capital also boosted its stake by 148%. On the other side, the Bank of Montreal dumped almost its entire position. The institutional world is as divided as the retail one. Some, like Citadel, are clearly placing a bet, while others are running for the exits. So what does Tilray actually do beyond the headlines? It's a company of 3 parts. First, there's the core Canadian cannabis business, which is a market leader but is stuck in a brutal price war. Second, there's the international medical cannabis business, particularly in Germany, which is growing and has promise. Third, there is the new diversified CPG business in the U.S. This includes Sweetwater Brewing, Montauk Brewing, and the wellness brand Manitoba Harvest. The entire bull case rests on the idea that these 3 components will one day merge, that the U.S. beverage and wellness footprint will become the distribution channel for the cannabis expertise, creating a CPG giant. The bear case is that these are 3 disconnected businesses, 2 of which are low margin, beer and Canadian cannabis, and 1 of which is not large enough to carry the entire $1.2 billion company. Looking ahead, the path for Tilray is binary.
The expectation is that U.S. rescheduling of marijuana from Schedule 1 to Schedule 3 will happen. This would be a monumental catalyst, not because it fully legalizes it, but because it would open the door for institutional investment, banking reform, and research, and would signal the end of federal prohibition is near. If that happens, Tilray's U.S. strategy, even with the hemp setback, suddenly looks much more viable. The risk, the reality, is that this process drags on for another year or two or gets derailed entirely by a new administration. In that scenario, Tilray is left to stand on its own fundamentals, and right now, those fundamentals are weak. It would be forced to prove that it can become a profitable beverage and Canadian cannabis company, a much harder story to sell. The analyst community reflects this uncertainty. The consensus rating is a hold, with price targets all over the map, from a low of 0.85 to a high